Michael Burry is one of the most successful investors of all time, and he's warning that another economic crisis is coming. In this video, we'll take a look at what he's saying and what it could mean for the markets. You are worried that the economy is on the brink of another major recession. The government and central banks have done nothing to prevent another financial crisis. Listen to the end to protect yourself and your family. Who is Michael Burry? Michael Burry was a hedge fund manager and physician who ran his own investment company, Scion Capital, from 2000 to 2008. He then abandoned the venture to focus on his personal finances. At the time, he made some of the earliest and most accurate predictions about this significant financial crash. He is largely regarded as a pioneer in that respect. What is he predicting? Economic experts are saying that a crisis is coming, but they can't agree on when it will happen. Burry believes that people are raiding their savings to protect against inflation, and that it is likely that the U.S. economy will become defunct once all the money is gone. Burry warned that consumer spending will skyrocket once their savings accounts are empty, and that the government will have to borrow more money to keep the economy from going into recession. Burry predicts calamities and disasters and has been tweeting about it recently. Burry suggested that falling savings rates and balloon credit card debts could undermine economic growth and hurt profits. We are in for a recession. It will cost us more money to live, he warned. Burry noted that U.S. consumers reacted favorably to the recent economic crisis by retaking loans that were granted to them by the government and paying them back in kind. He said he wondered whether Americans could ever get back the money they earned when the economy was strong. Now that inflation, rising interest rates, and falling asset prices have caused their finances to become very poor, he predicted that U.S. consumers could go into recession. Michael Burry was the one who predicted that the housing bubble would collapse in 2008 and who made huge profits from the collapse. Burry bet on the failure of Musk's Tesla Motors and Cathie Wood's ARK Innovation Fund last year and helped cause the meme stock craze to take hold by buying shares in GameStop just before the stock went up so dramatically. Use Michael Burry's predictions to prepare yourself for the crisis that is coming. Burry has been famous for correctly forecasting calamities and disasters. What caused the last economic crisis? The crisis that happened during 2008 was years in the making. By summer 2007, global markets were showing that the end was near for the decade-long glut of cheap credit. Two major Bear Stearns hedge fund managers are suing one another. BNP Paribas has warned that investors will not be able to get money from three of its investment funds. Northern Rock Bank, the biggest bank in Britain, was about to seek emergency funding from the Bank of England. But despite all the severe warnings, few people realized that the worst crisis in nearly 8 decades was about to cripple the global economy, bringing Wall Street to its knees and forcing the Great Recession to begin. It caused ordinary people to lose their jobs, their savings, or their houses. Those loans were also the seeds that caused the financial crisis that led to the 2008 financial crisis, when interest rates fell to record lows and lending standards were relaxed. Because of that, many people lost their homes. It all started, as it always does, with good intentions. After the dot-com bust, a series of accounting scandals, and the September 11th attacks, the Federal Reserve cut the interest rate by nearly 20%, from 6.5% in May 2000 to 1% in June 2003. There were early signs of economic distress. Many Americans became homeless because their homes were worth less than they paid for them. Bankers wanted to stimulate the economy by providing loans to businesses and consumers at bargain prices. Low mortgage rates caused prices to skyrocket as borrowers took advantage of the low interest rates. Even people who had poor credit were able to buy a house. They were able to finance the purchase. Some banks sold those loans to Wall Street banks, who then packaged them into so-called low-risk financial instruments such as mortgage-based securities and collateralized debt obligations. It was also possible to sell the securities originating the loans to Wall Street banks on the secondary market. In order to encourage investment banks to take on more risk, the Securities and Exchange Commission in October 2004 eased the requirements for investment banks to have sufficient capital to pay back the money they borrowed. They could then increase the value of their investment by up to 40 times, signs that something is up. Soon, interest charges started to rise and home ownership began to decline. In June 2004, the Federal Reserve began raising rates. By August 2006, the federal funds rate had risen to 5.25%. It stayed at that level until August 2007. There are already signs that people are experiencing financial distress. In 2004, home ownership was 69.2% in the U.S. In 2006, home prices began to decline dramatically. The number of homeowners was expected to keep on rising, but it turned out that the decline in home prices caused them to have much more serious problems. It really hit many Americans hard. Their homes had become worth less than what they paid for them. Many Americans were living in dire circumstances. Their houses were not really what they had paid for them. The Americans were left in a tough situation because they could not sell their houses and not pay the money to their lenders. If the mortgage was an adjustable repayment mortgage, the money that homeowners owe was going up as the value of their homes declined. Most subprime borrowers couldn't afford the mortgages they took out on their homes. What can we do to prepare for the next one? Some people are dreading the idea that there is a recession coming, and that may cause you to have problems planning your financial future. Those who are worried that the economy will soon turn into a recession aren't the only ones worried either, says a new survey from Empower and Personal Capital. 80% of Americans are worried about higher inflation, and 56% are worried that their standard of living will be impacted by higher costs in the future. While many experts say that downturns are normal, you should be able to cover your basic living expenses if one occurs. Number 4, take a look at your current resume and see if it is relevant. If it is, consider getting a second degree or getting a higher education to help you find employment. People are increasingly using the job market to look for good opportunities, but a recession is coming. People need to prepare for less overall job security if a recession strikes. Employment is at an all-time high, so naturally there will be fewer jobs available. So it'd be wise to get a new resume now to be ready for a job interview if your employer decides to lay people off. You may think that going back to school may help you get a master's degree or allow you to improve your current job skills. It is generally recommended that you have enough money to cover a minimum of 3 to 6 months of living expenses, but if you save a lot, it will help you to stay employed in the future, no matter what the economy is doing. Number 3, reducing expenses is important. Start looking for ways to cut back on spending in order to avoid future financial problems. How much money you need to cover your monthly living expenses depends on what happens if some of your expenses go unpaid in the next few months. You need to prepare for the worst case scenario. If your income suddenly decreases, what will happen to your savings? What happens if my car is break down or something happens to it? If a recession hits, how much money will you have? What ails you if my income decreases? What ails me if my rent increases? Start to think about the items that interest you and try to cut back on those purchases. Number 2, do not limit how much money you have in the bank. Put that money in a piggy bank. There are many ways to get to the goals that you want to reach, but don't get discouraged thinking about what it will take to achieve those goals. Anything that you can put aside will help you. Number 1, pay off all debt. If there is any debt that you can't afford to pay back, start working on it. Not having money to pay it back helps you if something unexpected happens to your job, but it will help you if future interest rates go up as well. The average interest rate on credit cards increased to 17.8% for the first time in more than 2 years because of the most recent Fed rate increase, creditcards.com reported. Federal Reserve policy is expected to keep increasing interest rates this year. Economic crisis is looming. The 2008 financial crisis was the result of the housing bubble, which was based on a mountain of faulty subprime loans. Investors continue to use risky loans, incorrectly believing that they can rely on government bailouts. Burry has been warning against this situation and is 100% sure that the situation will occur again. This is a big idea which, even if it doesn't turn out to be true, will probably be considered a brilliant prediction in the future.